Booyah! Let me tell you something. Just when you thought the market had a clear runway, the pilot decides to fly straight into a thunderstorm. That's what it felt like when President Trump came out swinging with his tariff announcements. 1 minute, we're talking about strong earnings and a solid economy. The next, bam, we're in a full-blown trade war conversation. These weren't just little tweaks, folks. We're talking about major taxes on goods coming in from all over the globe. China, Europe, Canada, Mexico. When that tariff news hit the tape, Wall Street reacted like it touched a hot stove. Ouch! The selling was fast, and it was furious. Let's talk about the big three, the indexes that tell us the market's temperature. First, you've got the Dow Jones Industrial Average. That's your 30 biggest, most iconic American companies. Think Boeing, think Caterpillar. These are global giants that sell their stuff all over the world. So what did the Dow do? It took a nosedive. We saw triple-digit losses day after day. It was a sea of red, a real gut punch for anyone watching their portfolio. Then you have the S&P 500. This one is the big kahuna, the one the pros watch. It's 500 of the largest U.S. companies, a much broader picture of the American economy. And don't forget the NASDAQ. That's my high-growth, tech-heavy index, home of Apple, Amazon, and all the innovators. Apple assembles its iPhones in China. The components come from all over Asia. So why all the panic? Why did the big money managers on Wall Street hit the sell button so hard? It comes down to one word: profits. The tariffs threw a giant monkey wrench into the profit machine for countless corporations. For a company like Ford or General Motors, tariffs on imported steel and aluminum mean the core ingredients for their cars and trucks just got more expensive. They have two bad choices. Either they eat that cost and make less profit, or they pass the cost to you, the consumer, and risk selling fewer cars. This isn't just about the direct costs either. It's about the ripple effect. Let's take a company like Deere, which makes those iconic green tractors. They sell a ton of them overseas to farmers in places like Brazil and China. When the U.S. puts tariffs on foreign goods, those countries retaliate by putting tariffs on American goods, including tractors. Suddenly, a John Deere tractor is way more expensive for a Chinese farmer to buy. Furthermore, the uncertainty itself is a killer. Businesses hate uncertainty more than anything else. A CEO needs to be able to plan for the future. They need to decide where to build their next factory, how many people to hire, how much inventory to order. Okay, let's bring this down from the skyscrapers of Wall Street to your street, Main Street. How does all this tariff talk actually affect you, your job, and the price of that gallon of milk? First, let's talk about prices. Remember, a tariff is a tax, and who ultimately pays a tax? You do. When a company like Walmart has to pay a 25% tariff on furniture it imports from China, it doesn't just absorb that cost. Now, let's talk about jobs. This is the tricky part. The whole stated purpose of the tariffs was to protect and bring back American jobs, particularly in manufacturing. The idea was that if foreign goods became more expensive, people would buy American-made products, and U.S. factories would need to hire more workers. Consider the American farmer. For years, they were told to grow as much as possible to feed the world. They became incredibly efficient, producing mountains of soybeans, corn, and pork. When the retaliatory tariffs hit, that market dried up almost overnight. Farmers were left with silos full of soybeans they couldn't sell, and prices collapsed. So, where does that leave us? What's the bottom line in this whole mess? The most important thing to understand is that the stock market's reaction wasn't just a knee-jerk panic. It was a rational response to a major increase in risk and uncertainty. The tariff saga showed us just how interconnected the global economy is in the 21st century. A policy decision made in Washington, D.C. can cause a factory in Germany to slow down, a farmer in Iowa to lose money, and a tech company in California to rethink its entire business. What should you, the individual investor and consumer, be watching for next? First, watch the negotiations. Are the leaders talking, or are they just shouting at each other through the media? Second, listen to what the companies themselves are saying. You also need to keep an eye on the big economic numbers. Watch the inflation data. Are prices for everyday goods creeping up? That's the tariff tax hitting your wallet. These are the vital signs that will tell us if this trade fever is turning into a full-blown economic illness. For now, stay diversified. Don't make rash decisions based on one day's headlines, and keep your homework cap on. There's always a bull market somewhere, but you've got to be smart to find it in a storm like this. Booyah!